Most people don't realize this, but if you retire with just $100,000 in savings, you're going to be broke in less than 5 years. Think about it. If you spend just $2,000 a month, your entire life savings is gone in 4 years. What happens after that? You go back to work, you rely on Social Security, or worse, you have nothing left. But what if I tell you that you can turn the same $100,000 into $3 or $4 million instead? What if you could invest it once and watch it grow without touching a single stock or worrying about market crashes? In this video, I'm going to show you and John the 3 best index funds that can make this happen. I'll show you how much each index fund can return, and in the end, I'll show you an index fund that has the potential to turn this one-time investment into a nearly $4 million portfolio and pay around $10,000 in monthly dividend income. So, how can $100,000 turn into $4 million? Well, it all starts with understanding index funds. An index fund is like a big basket filled with stocks from many different companies. Instead of putting all your money into just one company, you're spreading it across hundreds, which helps lower the risk. If one company struggles, others in the basket can still perform well and balance things out. Investors love index funds because they're simple, affordable, and have a solid track record over time. Unlike actively managed funds where professionals try to pick winning stocks and charge high fees for it, index funds simply follow the market. This means lower costs and more of your money stays invested, helping it grow. Plus, they require almost no effort. You invest, and the fund does the work for you. The best part is that investing in index funds isn't about chasing the next big thing or gambling on a single company. Instead, it's about trusting the long-term growth of the economy. While it won't make you rich overnight, patience and consistency can lead to incredible results. So now that you know how index funds work, let's look at the 3 best funds that could help you turn $100,000 into a life-changing $3 million. Coming in at number 3 is Vanguard S&P Small Cap 600 Index Fund with the ticker symbol VIOO. This fund is designed to track the performance of small cap companies in the United States. While large companies like Apple or Microsoft get most of the attention, small cap companies have the potential for faster growth, which makes this fund a unique opportunity for investors seeking long-term capital appreciation. These companies might not be household names, but they often grow faster than bigger companies because they're still expanding and have significantly more room to grow. That's why this fund is considered growth-focused rather than dividend-focused. Sure, you won't get the huge dividend payments right away, but if you're patient, the potential for share price appreciation is worth it. And don't forget about its diversification. It includes 600 small-cap companies from different industries, which helps reduce risk. If a few companies perform poorly, others can offset those losses. This mix gives investors broad exposure to the small cap market without putting all their eggs in one basket. On top of that, the fund benefits from Vanguard's low-cost structure, only 0.07%. Lower fees mean more of your money stays invested, allowing it to grow over time. Another key advantage of this fund is how it capitalizes on the growth potential of small-cap stocks. Historically, small-cap companies tend to outperform large-cap stocks over long periods. They're more agile and can adapt faster to changes in the market. While they may experience more ups and downs in the short term, patient investors often see substantial rewards over the long run. And let me tell you, investing in the Vanguard S&P 500 Small Cap 600 Index Fund ETF isn't about getting rich quickly. It's about letting your money work for you over many years. The early stages might feel slow, especially when the dividends are small, but staying invested through market ups and downs is key. Over time, the growth accelerates and the gains become more noticeable. Let's break down what happens if John invests $100,000 into this fund. For investing metrics, it has a dividend yield of 1.47%, a dividend growth rate of 11.18%, and a share price appreciation of 7.09%. Based on these metrics, after the first year, John's investment will rise to $108,560. By the 10-year mark, John's investment value would reach $233,758, doubling his initial investment. After 20 years, the portfolio would grow to $591,901. Not bad for something that started with $100,000 and no additional contributions. Finally, let's talk about the 30-year milestone. This is where long-term investing truly pays off. John's initial $100,000 investment, after 30 years, will be valued at $1,686,742. His annual dividends at this point will be $70,929, which means he would be earning around $5,911 per month just from dividends alone. All in all, the total value added to John's or your portfolio will be $1,586,742. Of the total portfolio value, $1,059,673 would come from the stock price going up, while $527,069 comes from your reinvested dividends. These are very good returns, but there are even better options to come. And in the end, I'll show you an index fund that has the potential to turn this one-time investment into a nearly $4 million portfolio and pay around $10,000 in monthly dividend income. Next, at number 2, we have WisdomTree US Value Fund with the ticker symbol WTV. This fund focuses on value stocks rather than growth stocks. While the previous fund was all about small companies with room to expand, this one invests in established companies that are undervalued compared to their true worth. This is called value investing. Think of it like shopping for deals. Just like you hunt for discounts at your favorite store, value investors look for companies whose stock prices are lower than they should be. Sometimes these companies have faced short-term struggles or have been overlooked by the market, but their financials remain strong. The WisdomTree US Value Fund takes advantage of these opportunities, making it different from funds that focus on fast-rising stocks. And unlike the small-cap fund we discussed earlier, which prioritized growth from smaller, more volatile companies, this fund invests in larger, more stable businesses. These companies may not grow as quickly, but they offer something just as valuable: consistency. When markets are turbulent, value stocks often hold up better because they're tied to companies with strong earnings, solid balance sheets, and reliable customer bases. This difference means that the WisdomTree US Value Fund often experiences less volatility. During market downturns, value stocks generally don't fall as hard as growth-oriented small caps. For investors who don't want to endure large swings in their portfolio value, this stability can be reassuring. At the same time, the fund's emphasis on dividend growth means that investors see their income increase steadily over the years, offering both peace of mind and a growing cash flow. Another reason this fund is appealing is methodology. The WisdomTree US Value Fund selects companies based on fundamental factors like earnings and dividends rather than just market size. This approach helps the fund identify companies that the market might be undervaluing, providing an opportunity for future price increases. Over time, as the market recognizes these companies' true value, investors can benefit from both rising stock prices and growing dividends. Fees also play a crucial role in long-term investing, and this fund doesn't disappoint. Like Vanguard, WisdomTree offers competitive expense ratios of 0.12%. One more point worth noting is the fund's strong dividend growth rate. It has a dividend yield of 1.49%, but with a strong dividend growth rate of 12.69%, it means the dividends paid to investors grow at a healthy pace year over year. Also, it offers a very respectable average share price appreciation of 9.77%. So what happens if you or John invest $100,000 in this ETF and let it sit for 30 years? Let's break it down. After just 1 year, your investment would grow to $111,260. Fast forward to the 10-year mark and the growth becomes more noticeable. Your portfolio value would hit $296,243, nearly tripling the original investment. After 20 years, the results are even more significant. John's investment will now stand at $923,317. Now let's look at the 30-year milestone, the real payoff for patient investors. John's initial $100,000 investment after 30 years will be valued at $3,078,146. At the same time, it'll be paying $93,349 in annual dividend income, or about $7,779 in monthly dividend income. The overall addition to John's portfolio will be $2,978,146. Out of the total value, $2,307,232 would come from the increase in stock prices, while $670,914 results from reinvested dividends. Up until now, we've covered the growth potential of small-cap stocks with the Vanguard S&P Small Cap 600 Index Fund ETF and explored value investing through the WisdomTree U.S. Value Fund. Now, at number 1, targeting the whole market, we have the Fidelity Total Market Index Fund with the ticker symbol FSKAX. This fund takes a broader approach by covering the entire U.S. stock market. This means it includes large cap, mid cap, and small cap companies, giving you exposure to the full spectrum of the market. Instead of focusing on just one segment, this fund allows you to invest in everything, offering diversification and stability with the potential for strong long-term growth. The Fidelity Total Market Index Fund shines because it offers the best of both worlds, growth potential and stability. Unlike the Vanguard S&P Small Cap 600 Index Fund, which focuses on smaller companies with higher risk, and the WisdomTree U.S. Value Fund, which targets undervalued stocks, this fund invests in all sectors and market caps. This means it's ideal for investors who want broad exposure without having to choose between growth and value strategies. One reason investors love this fund is the built-in diversification. With thousands of companies in its portfolio, the fund reduces the impact of any single stock's poor performance. This is especially helpful during volatile market conditions. While some sectors may be down, others often thrive, helping smooth out returns. This approach is perfect for those who want a set-it-and-forget-it investment strategy that delivers steady growth over time. As for the expense ratio of this index, it's one of the lowest in the market, standing at around only 0.02%. Another notable feature is the fund's strong historical performance. With an average annual share price appreciation of 10.53%, it consistently delivers solid returns. Combined with a dividend yield of 1.97% and a dividend growth rate of 12.13%, the fund provides both capital appreciation and a growing income stream. This balance is what makes it such a compelling choice for long-term investors. Now let's walk through the projection. If you or John invest $100,000 in this fund, after the first year, the investment would grow to $112,500. By the 10-year mark, the investment will be tripled to $329,030. At the 20-year milestone, things get even more impressive. The portfolio will be valued at $1,118,138. Finally, after 30 years, the $100,000 investment will grow to a staggering $3,945,793. That's almost $4 million. The annual dividend income at the time would be around $108,378, or about $9,032 per month, enough to cover anyone's living expenses comfortably. The overall addition to John's portfolio will be an impressive $3,845,793. Of the total portfolio value, $3,034,659 will come from the increase in stock prices, while $811,142 will result from reinvested dividends. Don't have $100,000 in savings to invest? No worries. Click the video on the screen to discover 3 dividend stocks that can surpass your full-time job with just a $50 per week investment strategy.